The most dangerous phrase in finance is, "This time is different." But for the yen carry trade, the reality is that the math has changed. In 2024, the cornerstone of global liquidity cracked. When the Bank of Japan, BOJ, finally raised interest rates, they didn't just tweak a number, they effectively pulled the plug on the global market's Wi-Fi. Recall our investor, Bob. For decades, Bob's trade worked because borrowing yen was free. But when the BOJ raised rates, two things happened simultaneously that ruined Bob's day. Borrowing costs spiked. Suddenly, that near-zero loan became an actual expense. Currency risk exploded. As Japanese rates rose, the yen strengthened against the dollar. If Bob borrowed 150 yen at $1, but has to pay it back when $1 only gets him 140 yen, he loses money on the exchange alone, even if his U.S. stocks went up. Suddenly, that 4% U.S. Treasury yield doesn't just look less good, it looks like a guaranteed loss. When the math flips, the capital flows flip too. This leads to repatriation, the process of Japanese investors selling their foreign assets, U.S. stocks, French bonds, Australian real estate, and bringing that money back home to Japan. The scale. Japan isn't just a minor player, they are the world's largest net creditor. If they decide to bring even a fraction of their trillions back home to earn a modest return in yen, it creates a massive vacuum in global markets. The flash crash signal. We saw a preview of this in mid-2024. When the BOJ hiked rates the second time, the Nikkei 225 plummeted 12% in a single day, its worst drop since Black Monday in 1987. The S&P 500 followed suit, dropping 6% almost instantly. This wasn't because companies were failing, it was because the carry trade was unwinding in a panic. For 30 years, Japan was the duct tape because they didn't care if U.S. treasuries were overpriced or if the yields were low. They just needed somewhere to put their cash. They were price-insensitive buyers. Now that buyer is leaving the room. As the U.S. continues to run trillion-dollar deficits annually, the Treasury Department must issue massive amounts of new debt just to keep the lights on. If the biggest buyer, Japan, stops showing up, who is going to absorb all that debt? The answer is nobody, unless interest rates go much, much higher to attract new, price-sensitive buyers.